Investment flash.
Oil surging on fresh Iran strikes and gold actually fell? The market's treating geopolitics like a footnote to the Fed. We're breaking it down.
Welcome to Investment Flash, London edition, Monday, July 13th, 2026. I'm Marie, alongside Tom and Gerald. Let's get into it. Tom, I've got to say, your weekend edition call on crude after Hormuz closed, USO, the U.S. oil fund, is up about 4% in a week. Not bad, buddy.
See? And my EasyJet buy up 2%. 2% is 2%. I'll take the win.
Yeah, but let's not forget your short treasuries call from the weekend. TLT, the long duration treasury ETF, is hugging its 52-week low, so I'll claim my victory on that too. All right, look, today's main event is the macro repricing from the Iran strikes. Fresh US strikes on Iran, and the reaction is bizarre. Oil climbed, but bonds and stocks fell, and gold, the classic haven, dropped. The Wall Street Journal says gold declined despite the geopolitics. It's all about rate hike bets.
Right, that's the core. Higher oil means higher inflation expectations, which mean the Fed has to hike more. So even havens get sold because cash is the only thing that will yield more. It's a rates over safety trade.
Which is why USO is the way to play it. It's up 4.2% in a week, but still 30% below its 52-week high. If this conflict escalates, there's a lot of catch-up room.
Yeah, but TLT is just 2% above its 52-week low. The short bond trade is crowded. One soft inflation print, and you get a violent snapback. I'm just saying, be careful.
But look at GLD, the gold ETF. Down 1.3% on the week, 5.3% year-to-date, and breaking below 380 support would be really bearish. The gold short actually makes sense here.
And the S&P 500 ETF is just 1% off its record high. Equities don't care yet. They're looking through the smoke alarm.
That's the sitcom part. Stocks ignoring the smoke alarm. Meanwhile, gold traders are hitting snooze on the Haven button.
Yeah, exactly. The only button working is the rate hike button.
All right, so sell TLT, sell GLD, buy USO, and hold your nose on equities for now.
Let's pivot to Japan. Toyota and its affiliates are selling billions in cross-shareholdings. Panasonic, Renesas, improving governance. Nikkei Asia covered it. TM, Toyota, is down 19% year-to-date. This unwinding could unlock value.
It's a hold for now, but the momentum is with the repatriation trade. Japanese small and medium companies exiting China, bringing capital home. That's why the Japan-hedged equity ETF, DXJ, is up 22% this year.
22%? And near a 52-week high. It's priced for perfection. I'm not chasing that, mate. A small long at best.
But the narrative is real. The SME exodus from China is a structural flow. It's not just a trade, it's a trend.
Agreed. Hold Toyota and a small position in DXJ. You can't ignore those capital flows.
Speaking of gold, the miners are doing their own thing. Genesis Minerals bid for Vault Minerals, and Regis Resources just walked away. The journal says the deal no longer met Regis's value threshold.
So Regis will live to fight another day. Prudent. Genesis is likely to get it now. No competition.
GMD.AX, Genesis, rallied 4.2% last session, but still down 19% year-to-date. Plenty of room to re-rate as the deal clears.
And Regis Resources, down 15% year-to-date. No catalyst. Hold it and watch. Maybe value emerges later.
Clear runway for Genesis.
Exactly.
100%.
Now, the week ahead in Asia is packed. Bank of Korea expected to hike to 2.75%. TSMC reports Q2 earnings, and China Q2 GDP seen at 4.6% year-over-year, down from 5%.
TSMC is the big one, up 36% year-to-date, price for perfection. Any AI demand disappointment, and it could sell off sharply. I'm nervous about that one.
If you're nervous, imagine South Korea. The South Korea ETF, EWY, up 80% year to date. A hawkish BOK hike could be a wrecking ball. Sell that.
And Chinese large caps, FXI, at multi-year lows ahead of GDP. Downside limited unless the data really surprises to the downside. So watch it, but don't short it.
TSMC earnings Thursday could actually be the pivot for the whole market. Blowout AI numbers might revive the growth trade and kill the rate hike narrative.
That's a big if. But fair, it's the event to watch.
Australia's renewable energy shift is driving a storage boom, and they're buying Chinese batteries like crazy. The FT says Australians are going gangbusters on BYD batteries.
BYDDF, that's the BYD stock, up 2.8% last session, but still down 15% year to date, trading at a cheap 13 times forward earnings. Early stage thematic play.
13 times forward for a battery play in a storage boom. That's not offensive. I might actually consider it.
It's one of those where the headline hasn't caught up with the stock yet.
Add it to the watch list or take a small bite.
Across to Europe, Nippon Paint offering €7.5 billion for an Akzo Nobel unit, trying to gatecrash a rival deal. The FT says it could spark a bidding war.
Akzo Nobel, ticker AKCZAS, flat on the session and down 4% in a week. The event isn't priced in at all. That's a buy.
I love a good gate crash. Mergers and acquisitions bankers popping champagne.
More like counting their fees before the deal closes. But yeah, Akzo shareholders could get a nice bump.
Simple, buy Akzo Nobel. Hong Kong's board lot reform will reduce the minimum trading unit for stocks like HSBC from 400 shares, boosting retail accessibility. The SCMP says turnover should increase.
HSBC is already up 23% year to date, near its 52-week high, so it's not exactly undiscovered, but the reform could extend the re-rating.
Yeah, but retail flows aren't going to move the needle that much on a bank like HSBC. I'd watch it. Maybe a small ad.
But improving market structure is always a win. I think it's a buy.
All right, this next one is the real sleeper. The Wall Street Journal reports a $250 billion wave of AI-related bond issuance, testing investors' limits. The investment-grade corporate bond ETF, LQD, is down 1.1% on the week and right at its 52-week low.
But Gerald, that's also a sign of massive AI capex. Companies are borrowing because they're building. For equities, that's bullish long-term.
No, but that's the risk. If the AI spending boom doesn't generate returns, these bonds become stranded. It's a double whammy with rate uncertainty.
Spreads are already widening. If LQD breaks below that 52-week low support, it signals real credit stress. Sell investment-grade bonds.
But if TSMC blows out earnings on Thursday, it validates the spending. The bond market might chill. So maybe this is temporary indigestion.
The bear case is real. A supply glut, peak rate uncertainty, and zero return yet. I'm with Gerald on this one. Short LQD.
All right, I'll put on my hard hat, watching that LQD level.
One more. Indian companies are turning to Chinese large language models for cost savings. Nikkei Asia says Baidu is a primary beneficiary.
Baidu is down 22% year to date, trading below book value, price to book of 1. If Chinese AI gains global traction, that's a contrarian cheapie.
I'm always skeptical of Chinese tech valuations, but at book value, it's hard to argue. Maybe a speculative buy.
It's a small bet on Chinese AI exports. I'd put it on the radar. So to wrap, today's signals show the Iran strikes are being processed purely through a rates lens. Oil surged, bonds tanked, gold couldn't get a bid. The cleanest expression is dispersion. Long USO versus short GLD. That plays the rates over safety dynamic directly.
And the S&P 500 near its record tells you equities aren't buying the doom script. They're betting on earnings, especially tech.
But TLT is 2% above its 52-week low. The short duration trade is so crowded that any hint of a data pause could cause a violent unwind. TSMC earnings on Thursday could be that catalyst.
And the gaps. No one's talking about a Chinese monetary response. If the PBOC eases to offset energy costs, China large caps could rally from multi-year lows. That's a huge catalyst missing from the press.
Also, if OPEC Plus signals more supply, the oil rally could reverse overnight. So don't get too comfortable in USO.
And don't forget the AI bond supply trade, short LQD. That's waiting for the day credit cracks.
So the play isn't one ticker. It's dispersion. Long USO, short GLD, and a side of short LQD.
Exactly. Strip out the equity beta and play the macro shift.
Dispersion trade.
That's the whole story?
Nailed it.
As always, none of this is investment advice, just three friends talking markets.
If you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
We'll be back with the New York edition later today at 9 a.m. New York time. Catch you then.